Hello folks, welcome back to our channel. So today the Bureau of Labor Statistics dropped the March jobs report, and it was actually a lot stronger than expected. After a scary jobs drop in February, the labor market just bounced back. So what does that mean for the Fed and the interest rates? So let me break it down. Let me break it down for you. So the U.S. employers added 178,000 jobs in March, and that's way above the 60,000 jobs that the economists were expecting, and it's actually the strongest gain since December of 2024. Also, February's number was revised to like we basically lost 133,000 jobs in February. This actually number was revised, so we lost more jobs in February than the previous number that we got last month. So, and this was actually mainly because of the healthcare strike that is over now. Job gains came mainly from healthcare and construction and transportation. Also, the unemployment rate ticked down to 4.3%, and that's down from 4.4%. So overall, the labor market is still actually looking good and still resilient. So how is that going to affect the Fed and their decision on interest rates? So as you know, the Fed is actually laser focused on two things: maximum employment and keeping inflation at their target, which is 2%. And right now, the federal funds rate is sitting at 3.5 to 3.75%, where it's been actually held steady since earlier this year. After the weak February report that we got last month, many traders started pricing in earlier rate cuts, but with today's stronger than expected rebound, actually that changes the story. It suggests that the February dip was just maybe a temporary thing, not the beginning of a big slowdown in the labor market. With hiring running solid again, the Fed actually has less urgency to cut interest rates anytime soon to support the economy. So after that announcement, after that new data release, Treasury yields rose as traders dealt back on any expectations for any rate cut anytime soon. Also looking ahead, the probability of a cut at the next FOMC meeting is right now basically zero. Also, expectations for any cuts later in 2026 have also come down sharply. Fed officials have repeatedly said that they're actually data dependent and they're in no rush to cut interest rates. Also, they're actually watching inflation closely, especially with oil prices still elevated from the Iran war, or the tension between the Iran and the Israel and the US. Anyway, a stronger labor market gives them more room to stay patient and keep rates on hold through the spring. Thank you for watching. I'll see you in the next video.